You know, every quarter, Wall Street kind of holds its breath for earnings season. But right now, the spotlight is absolutely locked on the big banks. Their upcoming reports are way more than just numbers on a spreadsheet. They could be the biggest signal we get about the health of the entire economy. So let's dive in and decode what's really going on.
All right, so this is the big question, isn't it? The one on every single investor's mind. After such a strong run, is all this optimism actually justified? Or are we, maybe getting a little ahead of ourselves? Well, the data offers a pretty fascinating clue. Just take a look at this. This line here shows the percentage of buy ratings from Wall Street analysts for all the companies in the S&P 500. And as you can plainly see, that line has been climbing and climbing and climbing, hitting a brand new peak. We're not talking about a small uptick here. This is a genuinely historic level of optimism.
And let's put a hard number on that optimism. 58.2%. That's the percentage of all analyst ratings on S&P 500 companies that are currently a buy. I mean, think about that for a second. Nearly 6 out of every 10 experts on Wall Street are telling their clients, yep, it's time to buy.
And to give you some context for that 58.2%, it completely smashes the previous record high. We are truly in uncharted territory when it comes to analyst confidence. So what on earth is driving this historic bullishness? Well, it all comes down to a really fundamental relationship in the market.
And wow, this chart just perfectly illustrates that principle. What you're seeing here is the S&P 500's price plotted against its forward earnings per share, or EPS. The two lines just move in this almost perfect dance together. When earnings go up, prices follow. It's that simple. And right now, analysts are betting big that earnings are about to look very, very good.
So, if earnings drive the market, where are analysts looking for the strongest signals? Well, they're looking straight at the banks. Because if you really want to know where the economy is headed, you have to start with the ultimate economic bellwether.
Yeah, the best way to think about it is this. The banks are the economy's engine room. They're the ones providing the capital that fuels literally everything, from small business loans all the way up to massive corporate takeovers. When that engine is running hot, the whole economic ship moves faster. And right now, all eyes are on the Q1 reports from the biggest players in the game.
And here they are, the titans we'll all be watching. You've got the huge names like JP Morgan, Bank of America, and Wells Fargo. Their upcoming earnings are so much more than numbers on a page. They are a direct readout on business activity all across the country. And there's one specific activity that has Wall Street absolutely buzzing. And that brings us to what's being called the M&A renaissance. If you're not familiar, M&A is just mergers and acquisitions. It's when companies buy other companies. And right now, it is back in a big way. And it's fueling a potential boom for the entire banking sector.
You know, it's not even just being called a recovery. People are calling it an explosive one. After things were pretty quiet for a while, CEOs and private equity firms are now out there making deals at a furious pace, and that has huge implications for the banks that advise them.
This whole thing is building on some incredible momentum. In 2025 alone, U.S. M&A deal volume hit a staggering $2.3 trillion. That huge number really set the stage for what we're seeing now in this first quarter. So the question is, why is this happening now?
It really comes down to one word: confidence. The Federal Reserve has been holding interest rates steady, which creates a stable, predictable environment for businesses. And when business leaders know what to expect from the Fed, they feel way more confident pulling the trigger on those big, game-changing deals. So how does that turn into profit for the banks?
Well, it's actually a pretty simple and really powerful chain reaction. When one company decides to buy another, they turn to the banks for two main things: advice on how to structure the deal and, of course, the money to finance it. For that service, banks earn these massive advisory and lending fees. So it's a direct line. More deals equals more revenue. Simple as that.
And hey, this isn't just a theory. We're already hearing it from the banks themselves. JP Morgan is on the record forecasting a big jump in their deal-making fees for the first quarter. They are literally telling the market, hey, this M&A boom, it's going to show up on our bottom line.
Okay, so let's just take a step back. We've got record analyst optimism on one hand, and a booming M&A market that's about to supercharge bank earnings on the other. Let's zoom back out for a second and connect the dots on what this all really means for the bigger picture.
So here's the key takeaway. Companies just don't spend billions of dollars buying other companies unless they feel very, very good about the future. A hot M&A market is one of the strongest indicators we have of corporate optimism. And when the banks report strong earnings driven by all these deals, it just confirms that business leaders are betting on growth. But is that confidence spread out evenly? Well, this is where it gets really interesting, because there's a crucial layer of nuance here. While overall optimism is at a record high, it is not the same everywhere you look. As you can see from this chart, sectors like tech and communication services are getting the most buy ratings by a long shot. But at the same time, sectors like consumer staples, the companies selling everyday stuff, they're lagging way behind. This tells us the optimism is really concentrated in specific, high-growth areas of the market.
Which brings us to our final question. We are seeing record-high confidence, fueled by huge comeback in the kind of major deal-making that signals real belief in the future. The upcoming bank earnings are going to be our first real test of this entire narrative. So, are we watching the market hit a new peak right before a fall? Or are these reports the opening bell for the next big leg of economic growth? We are all about to find out very, very soon.